Welcome. It's Drew Blazik. In these videos, so we got two different videos. We're going to do capital structure in both videos, and make sure you pay attention. Now, this is how we're going to upload the file. Is going to be a bit different than we've done in the past. So make sure you pay attention on this part. So if you go to, we have two files we have to upload to Blackboard. I'm sorry, to Canvas. And the first one we're going to look at is part one sim. So let me show you what you have to do. If you download it, you have to right click. When I right click on it, this is important. It does not show what I need it to show, which is properties. So I'm going to go to show in folder. So I want to see it in a folder. That's here. I'm going to right click on it. And I want to go to properties. Hold on, I'm going to move that box right here. And you see where it says this file came with another computer and might be blocked to help protect this computer. I want you to uncheck this. This is a safe file. I'm going to show you why. So hit OK. Now we can upload it. So what I did was I put codes on it that if you notice there's no questions, you just have a cover page. So what you have to do, you have to go up here in your name, type in the name, and hit enter. Once you do that and you hit unlock, the macro, it's called a VBA macro, it kicks in, and now the questions will appear. And your name is locked there, so then files cannot be shared. All right, so let's get started here. Okay, so the first question is the break even. We have machine A or B. The price per pair will be $12 regardless of which machine. So that's going to be the 12. So you want to plug that in. We got fixed cost, we got variable cost, and we have, before I start explaining that, so if you want to think about fixed cost, fixed cost is something that does not change. It doesn't matter if you produce 100 units or 1 unit, you still owe the fixed costs. Variable cost changes per unit. So if you produce 1 unit, it's going to cost you the variable cost per unit. So it could be a certain amount. This is $12. I'm sorry, $7 and $4 depending on the machine. So the more units you produce, the more the variable cost. Fixed cost will not change, which is 25,000, 100,000 for the machine. All right, so the break even, what you want to think about, the break even is going to be equal to, you want to take the fixed costs and you want to divide it by, and something called contribution margin, which is an accounting concept, which is what are you receiving per pair? Well, it's the price minus the variable cost. That's what we are, the contribution margin is what I'm receiving per unit. So the break even quantity for machine A is 5,000, which means I pay back all my fixed costs, and any more I produce, I'm making a profit. If I produce less, I'm losing money. So we'll do the same thing here. We take the fixed costs and divide it by, and make sure you bracket it. It's just the difference between the price and the variable cost. That's what you're making per unit. And that'd be 12,500. And then all the difference, what we want to do is show the difference between these. Next is return on equity. So we want to know what is the price per phone. That's 260. What is our expected unit sales? The expected sales level is 25,000 units. Again, it doesn't matter what machine you use. Then we have required equity for the investment. So we got pretty much everything. We got the price, we got the fixed cost, we got the variable costs, expected unit sales, and then this is the capital, how much capital we need for the investment for this project. All right, expected profit. So how do we calculate that? Well, expected profit will be, well, you got, and I'm going to bracket this. I have price per phone, that's the price per unit, minus the variable cost per unit. So that's what it costs per phone. And then I'm going to multiply that times the expected sales. So if you think of it that way, that's contribution margin. I'm making $50 per phone. I multiply times quantity. However, I still have to subtract out the fixed cost. So that's my expected profit. I can just drag it to the right to get the machine B. What is my return on my investment? So if that's my profit, I'm going to take the profit and I'm going to divide it by my required investment. So it's a 10%, other one's 16.67, and all we do is the difference between those. Part two, you work for a CEO in a new company that plans to manufacture and sell a new product, a watch that has an embedded TV set and magnifying crystal or glass crystal. The issue now is how to finance the company with only equity or a mix of debt and equity. Expected operating income is $160,000. So what is that operating income, EBIT? The company is small, so it is subject to interest deduction limitation. Other data for the firm are shown below. So let's kind of go through that. That's EBIT, so it's $160,000. And all we're doing is comparing the capital structure. This company has all equity, zero debt. This company has 60% debt. This is the required investment. That's the capital into the business. So here is the percent of debt down here. Now we want to know, well, how much dollars in debt do we owe? This one's zero because we don't have any debt. And this one is going to be 60% of our investment. And then what about common? Excuse me. What is the percent or the dollar value in equity? Well, the dollar value of equity is going to be 100%. Well, I guess I don't have to put 100%. It's just going to be all the investment. That's equity. And then this is 60% is of debt. That means 40% is equity. A bunch of ways you could do this. So I could take 40% of the invested capital, or I could have taken the capital minus the debt would be the equity. Operating income. So we'll go down the line, which is the 160,000. So this would be the income statement. What about the interest? Well, we pay zero interest in the all equity firm. And then we pay 9.99%. So I want to know what is the interest payment? It's the interest rate multiplied times the debt. And then taxable income. Taxable income is going to be your operating income minus the interest. And then how much are we paying in taxes? Well, it's your taxable income multiplied times the tax rate. And now we can get our earnings or our net income. So we're going to go equals. It's our taxable income minus our taxes. And then we want to know return on equity. Well, what is return on equity? Equity is the amount of money we are investing into our project of our own money. Debt is taking the bank's money, someone else's money. So what we want to know is what is our return on our investment? So we're going to take our net income and we're going to divide it by our equity. So we get 4.8% and 0.76. And then the difference in the equity is just the, oh, I know what I did. I think I did this one minus the other project. So it's negative 4.04. You're hired as CFO, a new company that's founded by 3 professors at your university. The company plans to manufacture and sell a new product, a cell phone that can be worn like a wrist watch. The issue now is how to finance the company with equity only, with a mix of debt and equity, or with equity only or with a mix. The price per phone is 250. The expected fixed and variable operating costs, along with the other data, are shown below. So we have a company with 0 debt and 62% debt. So first we want to know, what's the price per phone? That's $250. You can't drag it across because I have it separated there. So we got the fixed cost, variable cost per unit, require investment. Well, how much dollars in debt? Well, that's 0 debt company. How many dollars in debt? So that's going to be the required investment multiplied times the percent of debt. So I have that as a number. You can multiply it. So it's, oh, I have it right there too. I didn't see it when I hit that. So 62%. What is the dollar value of equity? Where this company is going to be the entire investment. We have to use all our money to start this project. And then this one is going to be another way of doing the equity aspect of it to find it out is, well, how much equity do we own? Well, it's going to be 1 minus the percent of debt. 1 minus the percent of debt would be the percent of equity. I'm going to multiply that times the required investment. What about the sales revenue? Well, that's going to be the price, $250 multiplied times the quantity. So we'll do both here. And then we got the fixed costs. And now we want to know, what is the total variable cost? Well, the total variable cost will be the variable cost per unit multiplied times the quantity. You know what? I'm just going to, for time's sake, I'm just going to do this side. What is the operating income? Well, it's the sales revenue minus the fixed costs. And I'm going to go minus, it's 1 up. You can't see it, but it'd be the variable cost total right there. That'd be the EBIT. What is the total interest? Well, the total interest, you know how to calculate that for the other side. Well, this one's going to be 0. So on this side, you're just going to take the total interest. I'll just do it for this part, is equal to the interest rate multiplied times the amount of debt that we have. That would be the interest payment. And what's our taxable income? We're going to take our operating income and we're going to subtract out. Remember, this is directly from the income statement. We have EBIT, earnings before interest and taxes, subtract out interest, subtract out taxes. And then our taxes are going to be the taxable income multiplied times the tax rate. And then the net income will be our taxable income minus, maybe 1 above, our taxes. And now we could do our return on equity. That would be our net income divided by how much equity we have in the business. So do the same thing there and do the ROE. All right, this one's a little more difficult. Spend some time on this one. You've been hired by a new firm that just is being started. The CFO wants to finance 60% debt, but the president thinks it would be better to hold the percentage of debt in the capital structure to only 10%. Both companies are small, so they are not subject to the interest deduction limitation. Other things held constant. The data is below. So what we want to do is there's a weight of high debt. That's the CFO. That would be the 60% weight. And then the weight of low debt, which is 10%. That's what the CEO wants. So we got capital, which is 4,000. We got return on invested capital, which is equal to the, if you guys remember this from a previous chapter, it's EBIT multiplied times 1 minus T divided by the capital. All right, so what we want to do, it's a little more difficult. We want to calculate this. I'm just going to do one side, and I expect you to do the other side. Let's do the higher side. So we're going to go, okay, what is the percent of debt? Well, the percent of debt will be the 60% multiplied times the capital. What about EBIT? Is EBIT even given in this question? It is not given in this question. There's no EBIT, but if you notice over here, the operating data, we have ROIC, we know it's 16%, and then it equals EBIT multiplied times 1 minus T divided by capital. So rearrange this equation, right? I'm not going to touch ROIC or EBIT. I'm going to move this to this side or I'm gonna multiply both sides by the capital. So I'm gonna move capital up there. So it's 16% times the capital, and then it'd be divided by 1 minus t. And that would be our EBIT. EBIT would equal ROIC multiplied times capital divided by 1 minus t. So let's do that. It's gonna be equal to, again, 16%. And then I'm gonna multiply it times the capital. And then I'm gonna divide it by 1 minus the tax rate of 25%. Next, what is the interest we're paying? Well, if you notice, if you have a higher debt, you pay a higher interest rate. If you only go with 10% debt, you're less risky. Therefore, you're given a lower interest rate. So our interest payment will be, this is the higher part, so it's going to be the 13% times the debt that's right here. And then we got taxable income. Well, I'm going to take my EBIT and I'm going to subtract out the debt or the interest. Now we want to find out the taxes. Well, I'm going to take our EBT. I'm going to multiply it times the 25%. Next is our net income, and that's going to be our taxable income minus our taxes. And then how much equity does this company have? Well, like I said, there's a bunch of ways of doing it. What I'm going to do is I'm going to take our capital and I'm going to subtract out the debt, and the remaining must be the equity. And now we want to know, what is the return on equity? Well, that's going to be the net income divided by the equity. There you go, especially the lower part. Last question here. Dye Industries currently uses no debt. But its new CEO is considering changing the capital structure to 74.8% debt by issuing bonds and using the proceeds to purchase and retire some common shares. So they're going to change the capital structure. So we have a beta, which tells you we're going to do CAPM, capital asset pricing model. A couple things I want to point out here is that if you go back to the PowerPoint, there's something called I always forget the name, the Ramada equation, that if you take an unlevered beta, and you have to, unlevered beta means there's a company with no debt. And if you add debt, that adds risk. That adds the required return to be greater. You add debt, you're going to make more, but if you don't sell them, you're going to lose a lot more because of debt. So what we have to convert is our beta. We have to convert our beta into a levered beta with that increased debt of 74.8% on that. All right, so go to the PowerPoint and look. It's not called the Ramada, it's called the Hamada equation on that. All right, so what we want to do is, wait, I'm just making sure I'm recording. All right, we want to find out what is the debt to equity ratio. The reason why I want this is part of the Hamada equation. I'm going to pull that up for you real quick, but I'm not going to keep it long. It's in the PowerPoint. It's on slide 29 if you want to look at it. So the unlevered beta is equal to the levered beta, which means the beta with debt is equal to the beta without debt. You need a bracket at 1 plus, and then you need a bracket again, 1 minus taxes, multiplied times the debt to equity ratio. And you notice that the unlevered beta is multiplied times that whole thing. If you can't remember it, I don't remember it. But okay, so we want to look at is how do we find the debt to equity ratio? And we're trying to find the new capital structure. So what we're going to do here is I'm going to go equals. This is the target debt. So I'm going to use a percentage. I want you to think about this as a percentage. That if I take the percentage of debt, and what I needed to do is divide it by the percentage of equity. Well, if you know the percentage of debt, we know the percentage of equity. So I'm going to divide that by, and I'm going to bracket this, and I'm going to do that classic 1 minus the debt. So if I do debt divided by 1 minus the debt, that's debt divided by equity. If that makes sense. And just to show you, if you get the wrong answer, I do got some things that pop up. So that's important. So debt divided by equities, you could do the percentages, you could do the value, the actual dollar value, doesn't matter. Now what we want to know is what's the levered beta? Well, there is a unlevered beta of 1.4. So we're going to go equal, and I'm going to go, it's this unlevered beta. So the levered beta will equal the unlevered beta, and I'm going to multiply that times. So you got the unlevered beta, and you when you do these, you got to always make sure, I'm going to pull that up for us again, that the bracket is correct. So you get the unlevered, and you want to do 1 plus 1 minus t. So we got 1 plus, and then we want to bracket that, and we want to do 1 minus t, which is the tax rate, 23%. And then I'm going to close that, and then I'm going to multiply that. Let's make sure I'm doing it correctly. 1 minus 2, you want to multiply that directly times the debt to equity ratio, which is right there. And then I'm going to close the bracket, and that would give us R. And that did not work. Why didn't it work? If you notice what I did here is I took this, the unlevered beta, and I just put a bracket there. I have to multiply it. So we got 4.6. That's the levered beta. So the unlevered, so it shows you if you increase debt, it increases the required return. We expect to make a higher profit if you increase the debt. So what we want to know is what is the required return on the unlevered and the levered beta. So this is the kappa model. So we're going to go equals, it's the risk-free rate plus, this is the unlevered beta, so it's the 1.4, and we're going to multiply it times the market risk premium. Now what we want to do is, what about the levered beta? What's the required return? We expect a higher return because we're adding risk. So it's going to be the levered beta, the 4.6. I'm sorry. It's the risk-free rate plus the levered beta. And that'll be multiplied times the market risk premium. And then that's just the difference again. Go Bucks. That's it. Just remember when you do these, we got part 2. So I want you guys to upload both files. I'm going to have a upload for both on the sheet. So I have a part 1 upload and part 2. We'll keep it separate. God bless. Thank you for listening.